Alright, in this lesson we're going to be looking at purchasing merchandise. But before we jump right into that, we are going to take a quick review. So, from lesson 1, we should be able to answer this. What are the two systems for tracking inventory? A company has starting inventory of 15,000, purchases 2,000 during the month, and has an ending inventory of 13,000. What is the cost of goods sold? And finally, our question here, if the operating expenses were $5,000, what is the net profit or loss for the month? I'd encourage you to pause the video at this point to try and answer these on your own. Those two systems are periodic and perpetual. Okay, and if they end up having these numbers here, we're going to have 15 plus 2 minus 13, which should give us 17 minus 13, which is $4,000 for cost of goods sold. And finally here, if we have operating expenses of 5,000, it unfortunately will be a net loss. 4,000 minus 5,000 will be brackets $1,000 to indicate a net loss. So here's some terminology which we got to see in the last lesson, which was 2-10 and N/30. What do they mean and where are they found? Again, pause and see if you can refresh your memory on this. They do have to do with invoices. So 2-10 says that if you pay the invoice within 10 days, there's a 2% discount, and it is expected that the full balance is paid, the net balance is paid within 30 days, but there's no discount. And these are terms found on purchase invoices. And so we get into our next question here, question for thought. Who pays for freight costs? Are freight costs recorded as operating expenses, or are they added to merchandise? And how do we record the purchase of merchandise discounts? And that's exactly where we're going with this lesson here. So we're going to get into explaining who pays freight costs and how we actually do record those discounts. This is lesson 2, purchasing merchandise. And just recall that in a merchandising business, generally speaking, merchandise is the largest account. So here's some terminology which we're going to get to see come up, and we will need to be careful as to whether or not we're talking about shipping point or destination, and it will be very specific as this will tell us who's paying for the shipping, and then from there we can decide how we actually do or use that information. So FOB stands for free on board. It indicates the buyer takes ownership, but when the buyer takes ownership of the material or the merchandise. So for example, free on board shipping point means that the buyer takes ownership when it is loaded by the buyer and pays the freight fees. That's because they're taking ownership before it's even left the manufacturer's place or seller's place. In contrast, we've got free on board destination, which means the buyer takes ownership when it arrives and the seller is responsible for the freight fees. So shipping point means that the buyer of the merchandise is paying for the freight fees, and destination means that the seller pays for it, and we do not include any kind of calculations or anything related to freight or merchandise fees when it is FOB destination. That is when we're talking from the buyer's perspective. So the cost principles basically says that freight costs and tax, it says this: accounting for purchases must be recorded at their cost price. And we'll get to see this as we go further into this course, where buying things like basket purchases of land and getting things up and operational, if we were doing something like a house, goes into the price or value of the property itself. If the buyer pays freight charges, they are recorded as an increase, which is a debit in the merchandise inventory. HST, on the other hand, is not, because it's offset when it is sold to the customer. So basically you're paying that HST and then you're going to remit it to the government at some later point in time, or you're collecting the HST and then it gets remitted to the government. So it is not included in the merchandising inventory. So we return to that idea of discounts. We've got two different discounts going on here. There's a quantity discount, which is a reduction caused by bulk discount. So for example, usually recorded as a percentage of the original price, meaning, say, if you buy X number of units, you get a 90% discount. So it requires no new entry, but we have to do the calculations involved in getting that 90% up and running. And then there's a purchase discount, which is what we've already seen. This is when we end up paying, or the purchaser ends up paying within that specific discount period. So like that 2/10 says that you would get a 2% discount, and that would result in a credit towards merchandise inventory. Purchase returns and allowances: if the buyer is not happy with merchandise, then it gets returned. and it's either going to be a cash or reduces the accounts payable depending upon when the bill was paid. If the return happens before the invoice is paid, then it just reverses that amount. So let's jump right in here. We're going to journalize the following. On September 23rd, $2,500 worth of merchandise is purchased with invoice 494 from Lenovo with terms 2/10 and 30. Freight costs are $100. Free on board destination point on September 26th. So this is a new date. $500 worth of merchandise is returned. And finally, Lenovo receives payment on the 29th, excluding tax. All right, let's work through this. What I would encourage you to do is pause at this point and see if you could do this on your own. The very first thing, let's start with September 23rd. We know that we bought $2,500 worth of merchandise, so we're going to be debiting that account. What are we going to credit? Well, it is an invoice, so it is an accounts payable. Let's start with that. Let's make this smaller so we can get our journal entries in here. So there we go with our first entry. Now, that's the first one. We've got this little bit of information here in the comments section. Freight costs are $100. Free on board destination, which means we don't actually need to worry about this because, well, we took ownership when it arrived at the destination, so this is not included in anything. If it said departure, that would be a different story. On September 26th, $500 worth of merchandise is returned, so that means this is before we've actually paid it. So we're essentially reversing what we did here. So our accounts payable gets debited and our merchandise gets credited $500. So there's our second entry. And finally here on September 26th, we pay the bill on the 29th. So 10 days plus the 23 would make it September 33. Well, yeah, basically we paid this bill within September, so we are going to get a 2% discount on this. So let's see how that works out. We know that we have a cash account that's going to be affected. We know that now the balance is not $2,500 but $2,000, and so 2% of $2,000 will give us a discount of $40. And so we need to erase the accounts payable off of here. So we know that accounts payable will end up being debited $2,000, and then the credits have to add up to $2,000. So one of those credits will be $40 for the discount, and the other $1,096 will be our cash account. So that's how we work through this. Again, if you ever get stuck on this stuff, just remember that you don't want to have accounts payable with any kind of dollar amount left over. And so this is our 2,000, and we end up having our changes in merchandise and cash here on the credits. All right, moving into the next example here. These things will get easier as you go through them and you get more experience. So September 23rd, 30 computers with an original cost of $400 each are purchased with cash. A 10% discount is applied. So this is a quantity discount. On September 24th, 3 computers are returned. Freight charges are $200 paid. Free on board departure point. All right, there's a lot going on here, so let's begin. We should start with the numbers. We've got 30 computers, $400 original cost. This is before the discount with a 10% discount applied, which means that we are purchasing these at 90% of the price. 90% of 400 means 360, and we got 30 computers. So 30 times 400 times 90% will give us the overall cost of these computers, which is $10,800. Now, you also could think of this as $360 per computer with the discount. So let's get over and start journalizing these. Right now we notice that this is paid with cash, so we don't have to worry about any accounts payable or any discounts related to that. We do have this September 24th where 3 computers are returned. So let's go see how this is going to be done. I'd encourage you to pause at this point and see if you can journalize these transactions first. The one tricky part about this is that this is free on board departure point. So let's go. The very first one, we're going to have a debit of $10,800 into our merchandise account. And what's being credited? Well, it is being paid with by cash. So bank or cash is perfectly fine. Now, we also have that return of computers. Wish we could see that here, but I think it's the 26. 3 of them get returned, which basically will reverse the order of this, which means our merchandise will go down by 3 times 360, which is 1,080, and means our bank gets in this case, or credit, it should be cash. Cash should be bank. It should be consistent. Will end up being debited 10,080. And finally, we have our free on board destination. What was our destination amount here? It says that we paid it $200 on the 26th, and we have to make sure that that money paid for this departure point is added to our inventory. So at the end, we're going to have another debit to our inventory. It will be $200, and that is again coming out of our cash or bank account. Really wish that this should have been bank to be consistent with the others. This is a mistake in the slides, but there you have it. That is it. That is how we make purchases, discounts, and things like that for this lesson. If you have any questions, reach out to me, and I'm always here to answer your questions. Have a good one.